Welcome to today's webinar on powering data centers in Germany. We will address this topic from an energy and legal perspective, and therefore this webinar is co-hosted with our partner enervis energy advisors and us, Watson Farley Williams. We have today over 500 attendees and are very delighted with the phenomenal response we have received. And therefore, let's start with a brief introduction round of today's speakers. And I'm happy to hand over to our colleagues from enervis.
Yeah, welcome from enervis and from us. My name is Julius Ecke. I'm managing director at enervis. We will be representing the energy perspective, on the challenges ahead for data center operators and the data center market. And I've been living and breathing energy economics for 15 years, and this is a perspective I want to bring to today's meeting.
Yeah, also a warm welcome from my side. I'm senior consultant in Julius' team and consulting off-tech clients in various energy sourcing perspectives with a focus on PPA.
Very good. Then we continue from Watson Farley. My name is Christian Schindler. I'm working for Watson Farley since 13 years now, and I'm an MandA partner in the Hamburg office and very much focused on joint ventures, co-development structures, all kinds of transactions, M&A financing, and also project contracts, procurement, construction, and usage agreements.
Yeah, good morning, everyone. My name is Rebecca Trampe-Berger. I'm a counsel in our Düsseldorf office. I've been practicing law since 2013 now, specializing in regulatory matters. So I advise clients from the telecoms and the energy sector, particularly always with a focus on digital infrastructure projects.
Okay, then we start this presentation, this webinar, with the legal part on data centers, and therefore we quickly start with an overview of Watson Farley. We are an international law firm, and we are worldwide specialized on the three sectors: energy, infrastructure, and transport. And in our 4 German offices, we have around 100 lawyers, very focused on transaction work, but also project development matters. And yeah, as you see, we are heading the rankings and the league tables in Europe and Germany, and have won, for example, the PPA deal of the year by IJ Global. Now start with a general market overview for data centers in Germany. Data centers are currently the dominant asset class for infrastructure in digital infrastructure in Germany, and there is a growth potential through generative AI, Internet of Things, machine learning, and cloud services. And we see a massive expansion of data centers in Germany in the gigawatt range. And one key point is the power supply for data centers, the topic of today's webinar, and also the combination with renewable energy generation facilities and the combination with battery storage. We have some regulatory challenges through the energy efficiency laws, in particular for the reuse of waste heat and the power usage effectiveness, PUE. And there are increasing requirements for DD processes. And yeah, in particular, the coupling with renewable energy is one of the key factors in the market. In the following graph, you see the current status of data centers in Germany. This is a DENA study for the German Federal Ministry of Economics. And you see the blue one is the current status end of the last year. We have around 1 gig of data centers in Frankfurt. Frankfurt is a hotspot in Germany. And then we have in Berlin, in Cologne, Düsseldorf, and Munich, in Hamburg, data centers. But the gray columns in the graphic show the currently planned data centers in Germany. And you see there is very much planning in Frankfurt ongoing. And and data center operators has, we think, 2 key commercial factors for the site selection, and that is at the first time to market, whether you have availability of grid connection. For example, in Frankfurt, there are new grid connections for data centers only available from 2030 onwards. And the second key commercial factor for the site selection is that there are customers available, because for successfully executing the development of a project, you need the customers. And hyperscalers, for example, have often a campus strategy and the potential to expand data centers with existing data centers. The availability of customers very much depends on the business case, and therefore we have prepared a brief overview of the categories of data centers, and all of these have a different risk and return profile. In Germany, we would say that 50% of the data centers are colocation data centers, also called colo, and these are the main category. Then the second one is cloud data centers and hyperscalers. And there are other types of data centers, for example, small enterprise data centers or managed services, or edge data centers, which are rather small and decentralized, but close to the user. And these ensures an low latency for specific use cases. And the last category, high performance computing, HPC data centers, they are for training AI large language models and scientific simulations and so on. But these data centers for high performance computing, they will be rather in the US or the Nordics, so several reasons. In particular, power prices and also limitations for data usage and data protection laws, which are more flexible in other countries than Germany and Europe. Okay, next. Then there are only few buildings which are more energy intensive than data centers, and single data centers can eat up more energy than in a whole town. Therefore, energy procurement is one of the main obstacles when planning a data center. And on the following slides, we want to have a look with you on the 4 core influencing factors for electricity procurement for data centers. And these are the lack of grid connection capacity, and also the competition with battery storage. Then the regulatory requirements, the fluctuation in electricity demand, power peaks, and the cost stability. Next slide.
Yes, so here you can see several recent headlines in the German press illustrating the pressure on Germany's energy infrastructure due to the rapid growth of data centers and energy storage systems. So in the middle, you see Bitkom warning. This Bitkom is one of the biggest industry association. It warns that Germany needs more data center, but the transmission system operators already have over 650 connection applications for battery storage system with over 226 gigawatts of installed capacity. And this doesn't even include applications submitted to distribution network operators. So the main takeaway is here, without an accelerated grid expansion and digital infrastructure planning, Germany will risk falling behind. Next slide. Thank you. So therefore, grid connection is the bottleneck for data center initiatives. So let's break down, why is this such a limiting factor? Data center, as we have already heard from Christian, compete with other projects for limited grid capacity. And this competition can lead to delays, prioritization conflicts, or even rejection by the grid operator for the connection. According to the German Energy Industry Act, network operators are obliged to enable a grid connection, but only if it is technically and economically feasible. And feasibility depends always on the available capacity, infrastructure readiness, and also costs. So if the grid needs to be expanded or reinforced to accommodate the data center, the operator must pay a performance-based construction cost subsidy. And this can be a significant financial burden, and it must be factored into the project planning. Next to it, also grid connection supply contracts must be concluded, and they must include provisions for grid congestion and also grid outages. So these clauses are really essential to ensure operational liability, and they define also the responsibilities in case of disruptions. So this all means that grid connection is not just a technical issue, it's a strategic one and also a regulatory challenge. Data center operators should engage early with grid operators to assess the feasibility of the grid, and also they have to prepare for potential costs and also delay when building the project.
Okay, there are different regulatory requirements in Germany. And let's start with the power usage effectiveness. This is a metric used to measure how efficiently a data center uses energy. And it's stipulated in the German energy efficiency law, Energieeffizienzgesetz. And it compares to the total energy consumed by the facility and the IT equipment alone. And because data centers don't just power IT equipment, they also need energy for cooling systems, lighting, power distribution, and other infrastructure. That's why the total energy consumption is always higher than the IT energy consumption, and making the POE always greater than 1.0. And a lower POE means a more energy efficient data center. And operators therefore aim to reduce the POE by improving cooling systems, optimizing airflow, and using more energy efficient infrastructure. And they're binding POE targets as laid down in the energy efficiency law for data centers which are commissioned before 1st of July 2026, 1.5 from 2027 and 1.3 from 2030. And for data centers commissioned from 1st of July 2026, only 1.2. And the current market average is at the moment 1.46. Therefore, there's a lot to do, and new data centers need to consider new technological cooling solutions, like, for example, liquid cooling or direct-to-chip cooling. Then the second point in the energy efficiency law is the reuse of waste heat, Nutzung der Abwärme, called in Germany, and there are requirements for the years beginning 1st of July 2026, at least 10%, and the next year 15%, and from 1st July 2028, this rises further to 20%. And this is a little bit a chicken and egg problem, because in several occasions there is no off-taker available for the waste heat. Therefore, this is currently in this discussion whether to amend the energy efficiency law, that it's sufficient that it is offered to take off the waste heat. But if there is no local off-taker available, this should be sufficient, considered sufficient. But this is an ongoing change of the law, and the current exceptions in the law are if there is already a contract in place with a local authority or a district heating network operator for a future use of waste heat. And in fact, there are other practical hurdles, in particular that most municipal district heating networks are operating at temperatures between 65 and 90 degrees Celsius, and the heat from data center is much lower. Therefore, it needs to be improved by heat pumps to get more hot, and that shows there is some need in the energy efficiency law, and that's also raised by several market players, and we expect and our colleagues from enervis will tell us later in their presentation more on the legal challenges, legal changes which are in the process of being adopted. Okay.
Yes, here we want to have a look at the regulatory timeline for sourcing electricity in data centers. So you can see since 1st of January 2024, data centers must procure at least 50% of their electricity from renewable energy sources. And operators of larger data centers will need to fully transition to green electricity by 2027. For example, through PPAs, guarantees of origin, on-site renewable generation, or certified green electricity from suppliers. So bigger data centers really have to plan to start planning now to ensure compliance by 2027. And this also influences site selection, contract structures, and also investment in renewable energy partnerships. And as you can see, also there are different ways for data centers to source their energy. The traditional method is market procurement. So you buy electricity directly from the grid at market prices without any long-term contract or guarantee of that the energy comes from renewable sources. But this definitely won't help meeting regulatory requirements in the future. So a more sustainable approach is therefore a power purchase agreement for renewable electricity, typically covering but only the base load. So this means for peak demand periods, you will always need additional electricity procured from the market. This is a hybrid model, and this balances sustainability with flexibility. There is on-site generation and off-site generation. So some data centers install solar panels or other renewables on-site, and this reduces reliance on the grid and can help meet the renewables energy quotas. But as said, it usually covers only a portion of the total energy demand, because also the site areas are limited in size. Off-site generation just means the data center operator invests in or contracts with a renewable energy facility located somewhere else, not on the site itself. And this can be part of a PPA or also a direct ownership model, and it allows for larger scale renewable sourcing. The last one is the off-grid solution. So this includes gas power plants, combined heat and power systems, or renewable energy installations, and they operate independently from the public grid. So this means energy autonomy, and it can be useful in remote locations or for critical infrastructure, but they require significant investment and also planning. So now we will focus a little bit more on PPAs. So at first on the main advantages of PPAs, it's cost predictability and budget security. So with a PPA, the operator can lock in electricity prices for several years. So this gives a high planning security and protects also from unexpected spikes in energy costs. So there are different possibilities to negotiate about the price in a PPA. For example, you can have a fixed price PPA or a market price oriented one. With a fixed price, the electricity price is agreed upon in advance, and it remains constant over the whole contract period, so for several years. This means this is a high planning security, but the disadvantage is if the market prices fall, the data center operator might end up paying more than the current market rate. The market price-oriented PPA is linked to the actual market price of electricity, and this can fluctuate over time. So this means it's very flexible, and it allows you to benefit from market price drops. But the disadvantage is it's risky. So there can be price increases which can make budgeting even more difficult. So sustainability and regulatory compliance is one of the other advantages from PPAs, and also flexibility in sourcing models. PPAs are highly flexible. Operator can choose on-site, off-site, or even virtual PPAs, and they can tailor the contracts to their operational needs. And PPAs help to manage risks. So by locking in prices or structuring the contract over a longer period of time, data center can reduce their exposure to unpredictable energy costs or supply shortages. So now we're going to have a short look on different types of PPAs. This one is a physical delivery, an on-site PPA. This is just a basic overview. Our colleagues from enervis will take a deeper dive with you later on. So this slide illustrates how an on-site PPA works. So it's a model where electricity is supplied directly from the producer to the data center operator without using the public grid. So the producer and the data center operator, they are connected by a direct line. Electricity flows directly, and if applicable, guarantees of origin can be included to certify that the electricity is renewable. The data center operator pays directly, and this setup avoids grid usage fees and can offer more predictable pricing. And even though we don't use the public grid in this case, both parties may still need an electricity supply contract or a grid connection contract, especially if there is a backup or a peak load electricity is sourced from the public grid. And these two, this on-site PPA can also be a fixed volume PPA or a pay-as-produced PPA. These are just two different models. With a fixed volume, there is a set amount of electricity delivered regularly. And with pay-as-produced PPA, the data center pays for electricity as it is generated, and this can vary depending on the production. So on the next slide, we will see the off-site PPA. It's still a physical delivery, but off-site. This means the data center is supplied by the public grid. The producer feeds electricity into the grid. The data center withdraws it. Both actions are coordinated through a balancing group. And this ensures that the amount which is fed in matches the amount which is withdrawn. To manage this, a contract for a balancing group management must be concluded, typically with an energy supply company or an operator. And even though the electricity flows through the public grid, the off-site PPA established a direct commercial relationship between the producer and the data center. Guarantees of origin can be issued also as before to certify that it's renewable sources. And the last PPA I want to have a look with you is the virtual PPA. This differs significantly from the on-site PPA and the off-site PPA. With a virtual PPA, there is no physical delivery of electricity at all between the producer and the data center operator. Instead, the parties agree on a differential payment based on market developments. So it functions as a financial hedge, protecting the data center operator against price volatility in the electricity market. And because of that, the virtual PPA may qualify as a financial instrument. And this can trigger additional regulatory and compliance requirements. So how does it work? The producer sells the electricity to the market, typically via a marketeer or a stock exchange. And a virtual PPA is signed between the producer and the data center. And this includes guarantee of origin for every renewable electricity, and also the differential remuneration mechanism. And this means, very basically explained, if the market price is higher than the agreed PPA price, the producer pays the difference to the data center. If the market price is lower, the data center pays the difference to the producer. So this structure allows the data center to support renewable energy without changing its physical electricity supply. And the PPA is not tied to a specific location. So this also allows flexibility in the choice of generation facilities. So virtual PPAs are ideal for data centers that want to support renewable energy and hedge against electricity price fluctuations. And they don't need a direct physical connection to the producer, but it really requires financial expertise and may also fall under financial market regulations.
Okay. On the last slide, we want to raise some typical legal DD topics we see in data center projects. That's of course real estate, the rental agreement or the purchase agreement, and the security in REM. Then the building permit. The data centers are often in industrial or commercial areas. And of course, as already said, the grid connection reservation and grid connection contracts. In particular, also the obligation to pay the BKZ to the grid operator. There are also the regulatory requirements we have described above. They are also relevant for the permitting process of a data center, and also topics like utilization of a data center needs to be kept in mind, because if you have a data center with an utilization below 75%, it will become difficult to comply with the PUE factor and metric. And that's, yeah, the topics are related. And then on the other side, we have all the project contracts for construction phase and operating phase. Also, you need to secure, of course, a backbone dark fiber usage agreement for a redundant internet connection of the data center. Large hyperscaler data centers, they have not only 2 redundant internet connections, sometimes also 3 or 4 redundant internet connections with the required capacity. And last but not least, there are, of course, the customer contracts, which are depending on the business model, whether you have a colocation data center or a hyperscaler. Okay, last slide, conclusion and outlook. We think that there are energy efficiency and sustainability requirements which are increasing. Hopefully, the changes which have been announced in the coalition agreement will be implemented very soon. And there are increasing demands on cybersecurity, as you might have seen this week. This is a massive threat also for data centers, and the airports in London and Frankfurt, Berlin, they have been affected by cyber attacks. And this also relates to data centers, of course. And the success for development projects depends very much on the time to market. That's the relevant factor for the site selection, and the availability of grid connection. And let's see how we can attract AI data centers in Germany. Probably the high performance data centers, as already mentioned, will be in the US and the Nordics rather than in Germany. But we will see a combination of data centers and renewable generation facilities, and also battery storage. And that's our last slide, and I hand over to Simon, and yeah, to you.
Thanks, Christian. Thanks, Rebecca. Happy to complement this with our energy economic point of view. Quick note at the beginning, what kind of services, projects we actually do in the data centers here at enervis. We support clients with strategy projects, hands-on sourcing. So, for example, finding the right kind of PPA, contract design and negotiation, often together with our legal partners, and more model-based pricing valuation services. Always integrated and flexible to deliver optimal outcomes. So, and this is the perspective we bring to this presentation. So I want to paint you a picture of, well, where is the power demand going? What kind of challenges do these projects have from an energy point of view? And how can sourcing models contribute to solving those challenges, addressing those challenges? Quick note on the power data center development from an energy point of view. There are projections, you have seen many of them, that power demand and capacity might increase like 80%, 55% respectively by 2030. And this is probably a good estimate, right? But we all know that there's a lot more projects out there, right? So we've been talking to our partners in the market and trying to come up with an estimate. What's the early stage pipeline of data center projects? And we see early stage pipeline of 20 to 25 gigawatts in the German market, right? And that is factor 5 of what the central projections in public studies see. Just as a mental exercise, what would that mean as an energy market effect, right? 25 gigawatts of data centers, that would be 190 terawatt hours of power demand. And that's huge. If you multiply that with a typical power price tag, you have a market of 16 billion power to data centers alone in the German market. Of course, only a share of those will actually do FID and be executed, but still, as a mental exercise to see what's going on size-wise in the market, it's certainly interesting. A good power sourcing strategy can contribute cost savings of 2 to 5 euro per megawatt hour. So the cost savings alone, if you assume a full execution of the pipeline, is up to 1 billion a year. That is very significant, and certainly this explains the dynamics of the markets going on and why so many energy market players also here today, project developers, utilities, suppliers are interested to a very significant degree in regards to what data centers are doing as energy off-takers. So these projects, depending on how many of them realize, face similar challenges, and power sourcing strategies can help to address those. We see 4 energy challenges for data centers. First and foremost, maybe a lack of grid capacity. The numbers for data centers alone, 20 to 25 gigawatts of early stage, plus the hundreds of gigawatts that we have early stage for battery energy storage systems, mean that there's a clear lack, and having availability of grid capacity can provide a very significant edge to the project that have those capacities. So the first challenge. The second, sustainability requirements. As all data center operators here know, the industry is facing more and higher public scrutiny and sustainability requirements, also regulatory-wise, of course. And all the main project developers, operators of data centers are at the forefront of the sustainability discussion. The third challenge is cost stability and price hedging. We all still remember the price spikes in the energy crisis, and a good sourcing strategy provides a solution to that. And of course, cost efficiency. Last, but maybe not least, it's important to have cheap power. This gives a competitive advantage. So data centers want all that, and they have different strategies. And we started with a bit of a use case analysis here. How are facts on the ground-wise data centers, what kind of strategies do they actually use at the moment? And I think there are 4 main ones. The first one, I would say the clear market standard is PPA plus some kind of residual power supply contract, right? You have a PPA, and those can be very different. We will look into them into a moment. Plus, normally you have a utility contract or something that does structuring and delivers structure to the PPA and then to the off-taker. And we have different examples of that, shorter ones and longer PPAs, of course. Building on that, and certainly a higher ambition level, is the 24/7 PPA variant, which is a bit more common in the data center sphere versus other industries. This means the PPA comes with its own structure, basically often base load delivered to the off-taker. This means you not only have a PPA with a variable infeed, the structure is built into the PPA, and then you have a very high temporal resolution of power demand and power supply. This, to fully execute it, normally needs some kind of flexibility technology built into the contract that makes it a bit more ambitious, certainly. Then we have the energy hub. This means on or near site, you combine the data center with maybe a storage system, maybe some renewables. And this is also wherever the space allows it, so to speak. This is certainly interesting to look into. This can provide cost efficiency, but also it's a great lighthouse project to show to the market. And one step further in ambition level, the mostly partial off-grid solutions. This is a construct where you have technologies on the ground that really substitute grid capacity. We have looked into that for some clients, and with the case study you see here from public information, that's also something that's clearly been used. Comes with upsides, comes with downside, but here you can, at least for a time for sure, substitute grid capacity with a technological solution most often built on gas. So we have those challenges, we have different strategies. How do they correlate to each other? This matrix shows you the established challenges in the columns and 4+1 typical high-level sourcing strategies. As introduced +4, +1, of course, you can always do standard sourcing. You go to the power market and maybe you buy some GOs on top. And in the following, I want to discuss with you how the strategies are being weighted relative to those challenges. So let's do a bit of a deep dive into the sourcing models. Different metrics. Here you see the sourcing models in the column and some key characteristics, most noticeably advantages and disadvantages in the rows. On the left, standard sourcing model. What does that entail? Well, you go to a utility or you have some kind of market access contract and go to the market and you buy power, right? And since you're a data center, most of them you will also buy GOs via different market access or integrated into the contract to the utility itself. This has advantages. It's clearly something that's also present in the market, but it also has disadvantages. Advantages, this is a relatively low operational complexity, of course. This is how power has been bought for, I don't know, decades, I guess. Yeah, and it allows a pricing that stays relatively close to short-term market fluctuations. It also means it's not a great hedge or something like that, but of course it's also an upside to have costs that relate very well to how the market generally is buying, so you can maybe transfer this to your clients. It's, I would say, not a great sustainability argument, right? There are in-depth discussion about how are GOs seen as a sustainability measure, but I would say the general consensus is it's not the most striking argument for sustainability, clearly. Now, if you move one column to the right, you have the offsite PPA. So this means you go to the market, you buy a PPA offsite, so delivered via the public grid, and you source directly from the producer or some kind of utility. Most often, in the physical variant, the power is then supplied to your balancing group. This gives a partial price hedge for the power object in the PPA, right? Not a price hedge for the structure that you also need to have to cover your demand effectively. Clearly, it has a bit of a better standing when it comes to decarbonization credibility. It's also a flexible and scalable instrument. You can buy relatively small PPAs and you can buy hundreds of megawatts of PPAs. All of this has been done. It's a bit of a higher complexity. You still keep structure risk, but nonetheless, it's, I would say, the market standard at this moment for the data centers, at least for the clients we work with. One step more to the right, you have the on-site PPA. This means you source renewables on or near your site with some kind of direct wire, for example. This means that you have a partial price hedge again for the power subject and object of the PPA. You still keep some kind of structuring risk and structuring costs. You can have economic upsides by avoiding grid charges to be paid. So if you have low cost renewables on or near your site, this is something where we see a reduction in cost footprint. It also means that you go a route with a bit of higher complexity. This is clearly not scalable to your power demand, mostly not on the site and certainly not over all your project. And as I said, the structural risk remains with the data center. You can take this one step further by investing into your own assets, either at your site or somewhere else. So let's say you buy a wind park somewhere in Germany and the power is then delivered to you. Well, this comes with the full costs, risks, and benefits of owning your own asset. It also, I would say, adds some fuzz to your business model. So most clients we look into this for find it interesting, but then in a cost-benefit analysis, decide to actually not go own generation wherever possible. So let's bring it together. You have those different models and you have those 4 energy challenges. And let's discuss how they perform relative to each other. And I will go by column by column. So if we look at grid capacity or the lack of grid capacity as a challenge, clearly, whether you go standard sourcing or you go some kind of PPA, there is no contribution to addressing the lack of grid capacity. You still go via the grid, so the grid capacity element is not impacted by this. And I mean, this is probably clear to most of you, but we still have many discussions in the market where this is not seen as clearly. Let's look at energy hubs. I gave it 1 bar. Well, the more bars, the better for the data center. I gave it 1 bar because mostly on a technical level, you don't really reduce the grid capacity need. But we see a very dynamic discussion on the regulatory side on grid capacity reservation. And the market at least think that at some point there will be rules out there where an interesting technical concept, for example, you have on-site renewables plus some kind of battery, for example, that would be an energy hub for sure, gives you a better argument, a higher priority to actually get grid capacity. If this is the case, then of course, an energy hub contributes to your lack of grid capacity, but this is a dynamic discussion and this is clearly not as clear yet. If you go off-grid based on some kind of gas model, well, you have full benefits relative to addressing the lack of grid capacity. This is why you're doing it, right? If you build some kind of gas power plant at your data center to substitute grid, you mitigate lack of grid capacity, at least partially if you do it for part of the capacity, or temporarily if you do it to, well, get an edge in the market and maybe commission your data center a few years earlier before you get grid capacity. Many clients of ours look into this variant mostly. So let's say I build a gas power plant and I get good capacity a bit earlier, and after a few years I'm still hoping to get my grid access and then maybe do something else with PPA and so on. Sustainability wise, if we move 1 column to the right, well, standard sourcing, I would say it's green if you buy GOOs, but maybe not as green. PPA and of course 24/7 PPA have a better standing in the sustainability discussion. Energy hubs, I rated somewhere on the PPA level. Well, at off-grid solutions, gas, if you build a gas asset as your site, even if you have a long-term decarbonization strategy built on hydrogen or something like that, well, it's an uphill battle, I would say. It's certainly looked as a bit more complicated when it comes to sustainability versus, let's say, a 24/7 PPA. Cost stability hedge. Standard sourcing allows some hedging activities for 1-2 years, as you most probably know if you're active in the energy sphere, but it's very limited. With PPAs, you can hedge at least the power delivered by the PPA for longer periods. If you want 10 to 15 years, the structural risk still remains with your entity, and the 24/7 PPA solves even that. Energy hubs, off-grid solutions, I rated somewhere in the middle because, well, energy hubs often are built on some kind of renewable power, so they provide some hedge. Off-grid covers the whole power of your data center, or at least of the part you want to take off-grid, but you're still subject to some gas risk, gas price risk, so some kind of risk certainly remains. And now the maybe most interesting challenge, the cost efficiency challenge. Standard sourcing as a reference, PPA plus residual can be more expensive, can even be less expensive than standard sourcing. This highly depends on what kind of PPA you actually want to source. And my colleague Simon will give you some details on that in a moment based on our modeling. 24/7 PPA is a bit of a premium product. This means you want 80%, 90%, 100% of hourly renewable coverage. And this is an ambitious target. And that ambitious target either comes with higher cost or certainly higher energy economic risk, right? This is also something that, 24/7 PPA are highly interesting for the data center sphere. And we look into them for some data centers. And the data center players are clearly driving this product, right? But still, it's something that hasn't been rolled out for, I would say, some reason, because, well, cost and risk are often entailed. The more energy, the energy hub and off-grid solutions, this is a case-by-case question, can come with substantial additional cost, I can tell you from our project. But the energy hub concept also doesn't have to be super expensive, could even save some money. So more case-by-case basis. This paints you the overall picture, and now my colleague Simon will take over and lead you through the cost efficiency discussion.
Yes, thank you, Julius. And I'm now going to take over to give you some insights on how we approach the PPA market with the clients, and also give you insights in our PPA market. And we will look at market segments, price levels, and what drives actual electricity costs. Julius, maybe you can go further. Thank you. And what matters in sourcing PPAs? So let's have first a look at market segments in Germany. Germany is the second largest PPA market in Europe, driven by, of course, a growing demand by electricity off-takers, especially at the moment data centers, but also from different renewable energy segments that have different revenue potentials, and also, at some point need PPAs to secure their revenues. And main driver of the market are unsubsidized new build projects, typically large-scale PV and offshore wind projects that need PPAs to get financing, because they don't get any subsidy from the EEG, either because they are not eligible or because they didn't want, because they bid for 0 cents in the EEG market auctions. So with this typically fixed price PPAs, they ensure revenue stability and also therefore bankability. The second market we see are new and existing assets with subsidy options. These projects may receive subsidies, but they have the option to opt out temporarily, for example, and enter PPA to potentially increase revenues. Therefore, of course, the PPA price needs to be higher than the EEG remuneration rate they get. But that's often an option in market times where overall electricity prices are higher. We saw that a lot in 2022 and 2023 happening. Now a little bit cooling down. And the third market segment are assets that have exited the EEG subsidy regime after the 20-year subsidy period, now having the need or the options to secure a short-term PPA to continue generating stabilized revenues. So here the pricing is more linked to actual market prices of the asset, with some kind of index variance, for example, to future markets or the spot market. Next slide, please, Julius. And as we have looked into the certain market segments, we will look at indicative price levels we're seeing out in our PPA tenders recently. So these prices are for pay-as-produced and pay-as-nominated PPA starting in 2026. And we see quite a high range between technologies, but also differences in new and existing assets versus post-EEG assets. It's dependent on the value, of course, of the generation profile of those technologies, but also on the opportunity cost of the asset classes to entering a PPA. And with PV and offshore wind, we see that both asset classes are more reliant to PPA, of course, because they need this revenue to secure financing, with price levels being more exposed to the actual capture prices or project economics like LCOEs. And the current developments we see in PV is, for example, that with the increasing deterioration of market values for PV and also higher increases in negative price hours, it makes it more and more difficult for PV projects to find buyers for PPA price satisfying their project economics, with 45 euros per megawatt hours being at the lower end to actually make the project happen. With offshore, it's a little bit different because it's more demanded by the industry, given its large-scale nature, allowing to source high quantities in one PPA, so you don't have to get into PPAs with many small projects. You have one PPA, and also the generation profile of offshore is of higher value and more aligned with your baseload structure, for example. With onshore wind, we see quite a high range because it's driven by the high opportunity cost, of course. So the EEG remuneration rates for the existing and new asset class. We saw in the last EEG tender rounds an average strike price of right below 70 euro per megawatt hours. But this is also dependent of the location of the project. So this is not, for example, a price that is relevant for all projects. So we see here the price level also needs to beat that. That's quite a large range, 70 to 90 euro per megawatt hour for onshore new assets. For post-subsidy onshore wind assets, prices, as I explained, are more market-based and below those ranges for new assets, as their revenue potential is now exposed to what they can achieve on the power market, and that is also reflected in the PPA price, of course. Next slide, please, Julius. As we've seen that there are different asset types with different price ranges, how do we know what actually are my electricity costs in the end and what asset types fit best to my need? And our way is to model a technology portfolio that cost efficiently fits your demand profile, taking into account, for example, different requirements regarding the overall green electricity share on your demand, the time correlation of demand and supply, and, for example, maximum of surplus volumes. Here, we are focusing on two things. That is annual matching, so the total annual PPA generation equals my total annual electricity demand volumes, and hourly matching, so the PPA covers my demand in each hour. And we look at different percentages between those two categories. To assess the price, we use electricity market modeling, and therefore, if required, in the projects, also with different scenarios and sensitivities. Let's have a look at what actually are the electricity costs when you use PPAs. For annual matching of PPA supply and demand with 100% PPA volume fitting my demand, that's the most cost efficient we see in our modeling. So PV is between 88 and 100 euro per megawatt hour, with onshore wind a little bit higher, because here we focus on new assets, and onshore wind new assets is just more expensive at the moment because of the higher opportunity cost. Here we don't have major surplus or flexibility costs because we focus on annual matching. So it's not really a matter of, okay, how can I best align those generation profiles of the PPA with my demand? We focus on annual matching. When we go to the hourly matching, up to 90% can still be competitive, especially when you're combining certain technologies, what we call a pooled portfolio. So this can be PV, onshore and offshore, that are mixed in the right way, that comes out from our modeling, and then you can be still competitive with annual matching options. But going beyond 90% hourly matching, it becomes significantly more expensive. You need either way more renewable energy capacity to actually meet your profile with a certain hourly matching percentage, or you need to add flexibility options like batteries or hydrogen. And costs for 100% can easily jump to like 130. If it gets really expensive with hydrogen, up to 200 euros per megawatt hour. So choosing the right PPA and also the asset mix is about balancing cost efficiency with a desired level of cost stability, of course, because when you have a 24/7 PPA that meets 100% of your demand, you're hedged perfectly, right? The question is if it's still cost competitive. And of course, it comes with a sustainability premium and a signal to the market what can be achieved when aiming for 100% real green electricity supply. Next slide, please, Julius. Thank you. But how do we get to this PPAs? And first of all, from our experience, PPA sourcing processes deserve serious attention. Even mid-sized sourcing projects can quickly hit hundreds of millions in lifetime budget when you are a large data center. And we consistently see sourcing approaches impact really PPA cost to like 2 to 5 euros per megawatt hour, which then translates, of course, into a lot of savings or overspend in the end when we look at 10 or even 15 years of PPAs contracts. So the takeaway is clear: invest in the process and also have a clear sourcing strategy. It pays off in the end. And we want to focus on 4 elements, making the difference in successful processes that align also with our project phases we are working with our clients. So strategy, tender, evaluation, and negotiation. And the first part is strategy. We are focusing on risk management, not market timing. We don't tell you by now the market is in the right place. We give you a strategy on how to behave in different market situations, and therefore energy market know-how is essential to identify those risks and categorize them and see, okay, what are we doing now? Also very, very, very important is define your preference upfront. This provides structure for the following phases of the sourcing process and also increases engagement from the sellers in your process because they know what you want and then they can adjust to your preferences. This leads also back in the negotiation process to a stronger position. The second one is tender process, and it's important to have a strong project management and continuous communication. You have often many stakeholders involved, not only the counterparty that is the seller, but also in your company that may be energy procurement, sustainability, legal and finance, that all are having a word in this, and you need to align upfront to have everyone on board and get this project through. This can be very coordination intensive, so be aware of that. Also, working backwards from the desired outcome and design the process based on what you want to achieve until when matters. Speed matters, so be ready for the deals when they are offered, but not at the expense of process quality. So standardization is helpful, but allow room for flexibility for deals. The third is contract valuation and pricing. To assess PPAs, and we saw PPA is not, the cost of a PPA can vary differently, and you need to assess that with modeling. So use robust modeling to compare offers. Better insights lead to better comparability, lead to better deals. And the fourth and last is negotiation. Going into PPA negotiations with too many non-negotiables kills momentum. Flexibility creates leverage, so define 2 to 3 issues that are truly critical for you. For example, price, credit requirements, termination rights, and treat the rest as something to trade. It's always a give and take, right? The second is preparation is critical. In the calls, assign clear roles, commercial, legal, technical. Make sure that your team is prepared. Having experienced team members help significantly for that. So successful negotiations rely on which topics are real deal breakers, where can we afford the flexibility, and who leads the argument in the room for what topic. So focus on not to win each clause, but to close a bankable and durable deal.
Thank you, Simon. And
thank you.
I guess this concludes our webinar with energy and legal perspective on the data center market. Thanks for joining today. And we don't have much time or no residual time for the Q&A, but feel free to reach out to our colleagues, Christian and Rebecca, or to us respectively if you have follow-up questions. And we're looking forward to continue this webinar and this discussion with all involved parties.
Yeah, thank you very much also from our side. And please don't hesitate to drop us a LinkedIn message. We will answer all your Q&As after this webinar.
Thank you for joining this webinar. See you.
Have a nice day. Thanks.
Thank you.